Good morning. Today we are going to discuss about income from house property. So income from house property is the second head of income under income tax. So how this income from house property is charged is under few conditions. The first one, it should be a building. Second one, the assessee must be the owner and the property should not be used for the business. Only then it is considered under the head called as income from house property. You can see a picture which clearly defines there should be a property and assessee should be the owner and a property should be used only for rent and not for business. So the basis of chargeability of income tax is the first one, it should have a building or land with connected with fences, and it should be, the owner should be the assessee, and it is charged on the annual value of the property. And even if it is a foreign based house property, it will be an assessee is liable to pay tax. And if there is a disputed ownership, the court can finalize who will be the owner, and that owner is deemed to pay a tax on the property. And if there is more than one owner, then all the owners are liable to make payment under the income from house property. So who will be considered as a deemed owner is if a property is in one person and that is being forcefully goes to another person without, even though the property is not purchased by them. Example, spouse. If one person passed away, it goes to the next person. So that is called as deemed owner. And when the house property income is exempted is in different scenarios, like income from agricultural properties, which is used for storing storehouse, and if it is used as a charitable purpose, and an income from house property is used for self-occupied, and any property used by local authorities or for any scientific research, in these scenarios, the income from house property is exempted. There are various types of property. The first one is let out property. Let out means a property which has been given for rent. And self-occupied property is it has been used by us for our accommodation. And deemed to be let out property is suppose I have more than two property, automatically the third property is considered as deemed to be let out even though I have not let out that property. And partly occupied for an year means 6 months I use for my own purpose, 6 months I let out. In this scenario, the entire year will be considered as a let out property. So there is a step for computing gross annual value. So point number one, how will you compute is first you will have to compare your MRV, that is municipal rental value, with fair rental value. So in this, whichever higher will be taken, from that you will compare with standard rent. Whichever is less, you will consider. From that, you will consider your actual rent what you received. Whichever is higher is considered as gross annual value. So you need to know a format how a tax will be levied, how you compute under income from house property. So this is a picture which shows you will have a gross annual value, which we saw in the previous slide, how to compute GAV. From that, you will deduct municipal tax. You get net annual value. From that, two deductions you do. One is 30% of your NAV, and second one is interest on loan, which will be pre-construction and post-construction. So we'll be discussing this terminologies in the next slide. So what is municipal rental value? In short, you call it as MRV. It is nothing but it is a house property fixed by municipal authorities. So the rental value will be considered by municipal authorities to levy the municipal tax. Fair rental value means it is a probable rent which is available in that locality. Say for example, the place where you live, if 2 BHK is there, almost majority of the 2 BHK will have similar rent. Yeah, so that is called as fair rental value, and standard rental value is fixed by rental authority. And you have annual rental value. It is nothing but the rent what you have received from the tenant. And you have composite rent. It's composite rent is a combination of rent which consists of all your amenities charges like lighting, gardening, swimming, cleaning, maintenance, etc. So that is considered as composite rent. The next term is called as unrealized rent. Unrealized rent means the rent which the owner was not able to collect from tenant. So there can be any genuine scenarios where the tenant was not in a position to pay rent to the owner, then that is considered as unrealized rent. And vacancy period. So sometimes the house will be kept vacant for 2 3 months. So that also can be deducted from your value what you are computing. And there are two important deductions. The first deduction is 30% of standard deduction from your net annual value. The second one we saw is interest on loan. In that we saw two terms, that is pre-construction and post-construction. So you can claim interest on loan if a loan is borrowed after 1499, maximum interest 2 lakhs you can claim. If a loan is borrowed before 1499 means only up to 30,000 you can claim. Suppose if it is a renovation, only up to 30 for after 1499, and the same thing remains 30,000 whether total whether it is for renovation or interest if you have borrowed a loan before 1499. Apart from this, there is another additional deduction of 1 lakh. Suppose you can claim under 80 EE, but there is a condition. A loan should be a fresh loan, and a loan should be taken only up to 35 lakhs, and it can be for the property which consists of less than 50 lakhs. In that scenario, you can claim up to 1 lakh addition of deduction under section 80 EE. So we were talking about what is pre and post construction. So pre-construction means an interest period starts from the day you borrow and it is end either your repayment time or your construction completion time. Whichever is coming early, that period is considered as pre-interest. In that amount, 1/5 you can claim up to 5 years continuously as a deduction. And post construction means it is nothing but it is a interest every year you compute annually. So you can see the picture here, a chart. The day you borrow loan, the interest starts and it ends either your repayment loan when you are finishing your loan, or else you are when you are finishing your construction. In this, whichever comes early, you have to take that for calculation. If construction is coming early, and you should take the preceding financial year, up to that only you can consider as a pre-construction period. Thank you. Hope this video was useful for you. Have a good day.